Good afternoon. Monetary policy frameworks are being actively discussed again as central banks around the world attempt to chart their course in the unfamiliar post-crisis economic waters. Central banks find themselves in similar circumstances. These flows act through different channels and therefore have different consequences. Thus, in the course of my lecture today, I will concentrate on how central banks have fared in the post-crisis era. And what challenges they face in shaping the contours of a monetary policy framework that can serve them well in the coming years. In some respects, EMs have had a head start in charting their monetary policy strategies as they revamped their policy frameworks in the wake of the severe financial crises that hit them in the 1990s. But reality reflects the importance of the exchange rate. Challenges posed by swings in exchange rates. Why do central banks care so much about the exchange rate? At a basic level, it's because the exchange rate is a core. Determinant of the nominal anchor in a small open economy. Exchange rates and the nominal anchor. Exchange rates impact domestic inflation through their effect on the price of tradables. To anchor inflation expectations in the face of destabilizing domestic currency depreciations. Central banks tend to tighten their monetary policy stance, usually by adjusting a short-term reference interest rate. In circumstances of extreme market volatility though, traditional monetary policy adjustment through Short-term interest rates might not be enough to preserve the anchoring of inflation expectations. So, while exchange rate pass-through has declined, it would be too complacent of us to assume that inflation has been vanquished. Before we delve deeper into the discussion about the appropriate role of the exchange rate in monetary frameworks, it is important to understand in greater detail the main avenues through which exchange rate fluctuations work across different layers of the economy. Exchange rates and export volumes. Let me start with exports. The role of trade finance has increased as global value chains, GVCs, have lengthened. Requiring greater financial resources to underpin their expansion. Exchange rates and domestic economic activity and financial conditions. In EMS, the exchange rate also affects domestic economic activity through financial conditions. Further complicating the central bank's task. Over the past 2 decades, the stock of foreign currency debt of EMS has surged. Driven in particular by the non-financial corporate sector. And in many cases it has not been matched with FX assets and revenues, giving rise to currency mismatches. Such currency mismatches on borrower balance sheets make financial conditions a function of the exchange rate. Even in the absence of currency mismatches on borrower balance sheets, exchange rate swings influence domestic financial conditions. Since foreign investors are subject to risk constraints in global currencies, The currency risk merely migrates from borrowers to lenders' balance sheets. Since central banks care about domestic activity, exchange rates matter because they influence long-term interest rates above and beyond the textbook transmission channels of monetary policy. The strong presence of global investors in EM markets further implies that financial shocks such as a change in AE's monetary policy or a change in investor sentiment. Can trigger portfolio flows that are so large that they can become a driver of the exchange rate. Taking account of exchange rates in monetary policy conduct. The link between exchange rates and domestic financial conditions and the weakening of the traditional trade channel have important implications for monetary policy. Moreover, thanks to the presence of powerful financial channels, exchange rate fluctuations push inflation and debt in opposite directions. Potentially raising an intertemporal trade-off for the central bank in the pursuit of price stability. In the face of these difficult trade-offs, traditional monetary policy response through short-term interest rates runs the risk of falling short of what is needed. FX intervention. Intervention in foreign exchange markets is a tool that can help shape more favorable trade-offs from exchange rate swings. FX intervention helps address the challenges from exchange rate swings in two main ways. First, through its effect on the exchange rate, it can directly counteract exchange rate swings that would have undesired effects on the inflation rate and on the real economy. Second, the accumulation of reserves has macroprudential-like features. At the same time, sterilist FX intervention counteracts the mutually reinforcing feedback loop. Between exchange rate appreciation and capital inflows that fuels domestic credit creation. The analogy with macroprudential instruments such as minimum loan-to-value ratios or the counter-cyclical capital buffer is obvious. However, holding FX reserves is costly, in particular in periods of very low interest rates in reserve currencies. As is the case currently, and especially in countries with high domestic interest rates. Thus, while national foreign reserves are an important element of the global financial safety net, they are quite costly and, also for that reason, will always be limited. Targeted policy measures. Besides FX intervention, central banks have also resorted to traditional macroprudential tools and, although less frequently, to non-orthodox balance sheet policies to deal with the challenges from exchange rate swings. The targeted nature of macroprudential tools has the advantage of reduced collateral damage if imbalances and vulnerabilities are concentrated in a specific segment of the financial sector. In such situations, central banks may instead resort to non-orthodox balance sheet policies. Central banks could also prevent capital flows, and thus exchange rate pressures. By facilitating the duration adjustment of portfolios in times of stress. Monetary policy frameworks, which way forward? What do all these considerations mean for monetary policy frameworks in EAMS? The textbook version of the inflation targeting framework. Which prescribes pursuing inflation stability with floating exchange rates through adjustments of a short-term interest rate. Is obviously too narrow for EAMS central banks. EAMS central banks have risen to this challenge through their innovative use of additional policy instruments. Going forward, EAMS central banks will need to further develop their toolbox. For dealing with the challenges of exchange rate and capital flow gyrations. EAMS central banks also need to contend with how to address the intertemporal trade-offs that exchange rate fluctuations have given rise to. Finally, EAMS policymakers need to consider measures to reduce the vulnerability of their countries to exchange rate gyrations. Thank you very much. Introduction. Good morning, ladies and gentlemen. On behalf of the Financial Stability Institute and the Bank for International Settlements, I am delighted to welcome all of you to our 20th anniversary conference. Over the next day and a half, we will reflect on the main post-crisis developments in financial regulation. The Financial Stability Institute is here to help supervisory authorities address challenges that could potentially threaten the financial system. Financial system weakness has been at the heart of the recent crises. In this way, capacity building in the official financial sector was baked into the FSI's mandate. which tasks it with helping supervisors strengthen their financial systems worldwide. The need to strengthen financial systems worldwide has led to increased demand for assistance in implementing sound policies in all areas bearing on financial system stability. Two people were instrumental here, the BIS general manager Andrew Crockett and the Basel Committee chairman of that time, Tom de Swan. Since then, the FSI has been constantly adapting and innovating to deliver on its mandate in a way that contributes to the BIS's goal of promoting financial stability. And which meets the needs and demands of the financial supervisory community. I would like to use these welcoming remarks to briefly review some of the key achievements. In the FSI's history and to share our current and future priorities in the years to come. A quick look at the past. At its outset, the FSI was guided by an advisory board chaired by Andrew Crockett and comprising a number of eminent officials including Jerry Corrigan, Bill McDonough, Guillermo Ortiz, Tommaso Padoa-Schiappa, and Michel Prada. To direct the Institute's day-to-day activities, John Hyman was appointed as the FSI's first chairman. In December 2000, Joseph Tosofsky became the second FSI chairman. Around the same time, there was a growing realization that the financial markets had evolved so far that the 1988 Capital Adequacy Framework or Basel I, could no longer adequately reflect the risks that banks were facing.